to another episode of Investing Explained. Here's today's question.
I love the question. I'm kind of at a point where Berkshire Hathaway has gotten so big. And when you think about their competitive advantage, it's really been kind of being in the right equities at the right time and kind of managing the portfolio. But I think when you get to be such a large company, to employ the capital in a manner that beats the market, I think becomes an incredibly difficult task. So when you look at Berkshire's performance over the last 15 years, it really hasn't outperformed the market by an incredibly large margin. It's been fairly consistent with like the S&P 500. I would suspect that that's going to persist. I think that for them to outperform the market in a major way is going to be very difficult for the new managers to do. And I think that the new managers are going to be extremely talented. Whether they're as talented as Warren and Charlie, I have no idea, but I think that they're going to be very talented people. I just think that they're fighting a fight with their hands tied behind their backs. Like that's a hard thing to do, even if you're really talented. And Warren and Charlie talk about this at the shareholders meeting. I think that they would never maybe come out and explicitly say it as the way that we just might have said it, but I think that they kind of see it that way. I mean, think about it, because their market cap within 10 years will be maybe $1 trillion, right? I mean, for where they're at now, it really depends on what happens on a macro sense. But if the company keeps growing, it's going to be very big. And so how do you employ that much capital and work deals that are severely undervalued? I guess I'm not convinced that that can be done easily.
Just an example, one of Warren Buffett's famous investments, that's the one in American Express. And back then, he put in 40% of the portfolio that he had. He can't put 40% of his portfolio in something that's significantly undervalued today. I mean, that's simply impossible. And since he can't do that, no, he can't make the same kind of a return. Bennett, I think you're right in the sense that Berkshire Hathaway has a competitive advantage having Warren Buffett and his brand, but it's probably not as significant as it has been. I mean, if you think of the deal that was made with Bank of America during the financial crisis, I'm pretty sure it's because of Warren Buffett's name and brand, if you like, that he could provide stability to the market. He could get the warrants in Bank of America for, I want to say, $7 each, and it's trading in like the mid-20s now. So yeah, that's $17 billion that he wouldn't have gotten otherwise, I guess, even with a new manager as talented as him, because he doesn't have the same track record. I think you will see less and less of like one-time deals like that in the time to come.
I think the only way you're going to get the company to outperform the index is if, for whatever reason, the price is punished really badly because of news that would come out. Like a perfect example would be just recently. So Berkshire was down really hard recently because of the Wells Fargo news that came out with the Fed limiting their growth. And so Berkshire took a huge hit. But when you take a step back and you look at how much stock Wells Fargo makes up of the overall Berkshire portfolio, I think that the company was severely punished relative to the rest of the market in that price movement. So if you have opportunities to buy it because of news like that might come out, or the news might be something much worse with reference to Warren or Charlie, you might have an opportunity to buy the company at a much better price. And I think that the performance is still going to be there whether Charlie and Warren are there or not.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.